Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we are going to be looking at UnitedHealth Group, ticker symbol UNH. I've had several requests for this one lately, especially after the Humana video that just went out, and after their recent stock price decline, which we can take a look at here in just a sec. Actually, let's just peek at what we're looking at here. Yeah, so like 15 to 20% down off the recent peak. It looks like around December maybe. As always, this is not individual investment advice. This is just how I analyze stocks, and UnitedHealth Group's pretty interesting. It fell along with Humana, but not quite as far as Humana after reimbursement rates for, I think it's next year, were announced for one of the Medicare plans. So, but we don't really see that reflected in their earnings. So whenever I look at a stock, the first thing I like to look at are the historical earnings patterns and what they look like, right? So that's this dark green area here on the fast graph, and this one looks pretty darn beautiful up and to the right almost every year. The only time they saw a significant decline, maybe any decline at all, there were some pretty slow years here, was during the Great Recession in 2008, in which earnings per share fell 30%. So this was pretty rocky period. Not only did earnings fall for them a lot, not enough to make it a cyclical business, but enough that if we do have a similar situation happen again, you definitely will expect the earnings to fall probably, and you would expect the stock price to fall. So not only did earnings fall 30%, but the stock price fell. Instead of measuring from this peak back here, which is kind of interesting because that's where the housing really peaked. We can go from here. That looks pretty low. Maybe we'll try to get down on that March low. And so 70%. So this stock fell 70, probably more like 75% if we got it at the absolute top to the absolute bottom there. So when you look at this beautiful earnings history, it's really hard to imagine that the stock price could ever fall that much. And this is why it's really important for investors to go back and look at the history. That is usually going to be your best guide for what to expect if similar situations arise again. And we know that the situations are never going to be identical, but you want to know what's possible, right? And then you can use your own judgment on how similar a situation might be. So if we look at the COVID decline, it fell probably over 30%, more like 35%. That's more in line with the market, but you can look, earnings didn't fall at all. So even with earnings rising 12%, the stock for a while fell more than 30%, probably 30. Well, we can look up here. So 300 to 200, I mean, that's like 33% or something, right? So, oh, no, that was actually the wrong year. We're looking, that was a much bigger decline. That's almost 50% actually from top to bottom. So, because that's almost half. So it almost fell 50%. So this is actually kind of in line with how we want to think about this. Now, it was a very quick decline in recovery, but it's important to understand what's possible, especially with such a strong earnings history. And so, because we can kind of start thinking things are invincible when everything is just always perfect, basically, and we can forget the potential downside. So, and what you don't want to do, like I guess my number one thing that I would stress is that will happen to people, or else the stock price wouldn't fall that far, is people will own a stock like this not understanding it could fall 50% or 70% in some situations, and then when it starts falling, they assume that something's broken and they panic and then they sell after the stock is down like 50%, right, or 40% or whatever. And that's not what you want to usually do unless there's a really good reason why something really is broken. It's really just kind of part of the normal, within the normal range of trading possibilities for the stock and within the normal range of earnings declines that could happen in certain situations, right? So just having that knowledge is really important. Even back then, they fell nearly 20%. It looks like, so just in 2022 with no recession. So this stock can go down. It can go down far, right? So that's what we need to start with, and it's going to play an important role once we get into the valuation. So even though that announcement came out, I didn't really see much movement in analyst expectations for earnings this year. So either analysts are late to the game and don't really understand, or it was this is too much of a knee-jerk reaction maybe by the market at this particular time. I don't know. I'm not an expert in this area. I just try to make rational decisions. I look at the history, I look at what analysts' expectations are, and I try to determine, and then I try to have a big margin of safety to make up for my ignorance, and usually that allows me to do pretty good. But, you know, it's not because I have like precise knowledge of anything. It's really because I'm mostly right and have a big enough margin of safety that when I'm wrong, I don't usually lose as much. And so when I do that over and over again, it produces pretty good results. So valuation, we're looking at a 18 PE roughly on blended earnings. These guys have a 16% growth rate. Let's go back. This was a slower year. So when you change this time frame on the fast graph, it will change the numbers here to match whatever time frame you have set. I think this is the time frame I chose to use for these guys. I wanted to get at least one slower growth year in here, just to kind of level things out, and then looking forward 1 year. So fast graphs produces almost a 16% earnings growth rate, about 15. That measures from this point here to looking forward 1 year and just kind of smooths all that out into the average return. Now, because earnings have only gone up, that's a pretty good method to use. It should be pretty accurate. When earnings fluctuate more, I make adjustments personally for that, the way that I do my earnings growth rate calculation. The other thing that I adjust for are share buybacks. And when I first looked at this, I expected these guys had bought back a lot of shares in order to inflate this earnings per share growth. But really, it looks like they only bought back like 6 or 7% of shares outstanding over the last 10 years or so. So I did make adjustments for that, but it didn't end up being like a super huge adjustment to try to figure out this earnings growth rate. And so what I had is I have almost 14%. So it's really very similar to what the fast graphs has. And that's really good earnings growth. Now, what this doesn't take into consideration is if we had, you notice there's no down years here, but when we had that bad recession in 2008, they had a year where earnings were down 30%. So that 13.8% earnings growth rate does not include an assumption that earnings will ever fall 30% for the next 10 years. So in that sense, it's a pretty generous earnings growth rate to assume. But I'm going to be more conservative in other ways. So I'm going to kind of present the, I would call it more of a standard kind of assumptions, which is what I have here without most people don't calculate recessions, which is why I call this a full cycle analysis, because usually I go back and include at least one like real recession. And it generally makes my assumptions more conservative than basically everybody. But also I think more realistic. I'm actually not going to do that for one method that I'm going to show you. And then I am going to use a different method to count for that potential recession with another method. And we can look at both of those and kind of see what they're telling us. And then we just have to kind of decide for ourselves which ones make the most sense. Now, when I was talking about Humana yesterday, I talked about how I got a little bit lucky because I kind of had my recession parameters on, and that kept me from buying Humana too soon before it, or paying too much for it before the price fell a lot. So I have the same thing going with UnitedHealth Group. And we'll see kind of the difference between the two of those. So right now we have, like I said, the 13.8 earnings growth assumption. I'm going to assume that they earn $27.76 this year. And I'm going to pull that forward. And then I'm going to apply that 13% growth rate to the earnings. And what I want to know is, if I own this business, if I just paid $100 for it, how much earnings could I collect over the next 10 years? And so I figure that out, and then I convert that to a CAGR, and then I look and see what if I owned the business, like what would the kind of owner's earnings produce. If those earnings were collected, if you own the business, you could just go spend them on something. And so I don't assume that they're necessarily reinvested or anything like that. Again, it's just another layer of being conservative. So let me back up before I get over there. I got two more things to talk about here. One is I also control for these guys do have a little bit of debt, it looks like. So what I do for that is I look at the market cap, I look at the total enterprise value, which includes cash, debt, preferred shares. They probably tell you on here. Here we go. So the market cap plus preferred stock plus total debt plus minority interests, and then you take out any cash that they have or short-term investments, okay? So I like to see what the difference is between the market cap and this. So these are other kind of like obligations that they might have, that if you were going to buy the business, you would have to buy those obligations too, in theory. And I like to see what percentage higher the total enterprise value is than the market cap. In this case, it's about 19% higher. So what I do is I take that 19% and I apply it to the stock price, and I basically raise the stock price by that much in order to reflect the real cost that if you were going to buy the company, you would actually have to pay. And so when I do that for UnitedHealth, I get a $541 stock price instead of the $455 stock price. What this does is it creates a more conservative earnings yield assumption, or PE. Now, the way I have this spreadsheet set up, this PE does not include the debt or whatever, but the earnings yield does. So once we take that into account, we can see what the earnings yield is. And one way to think about the earnings yield is if you bought the stock or the business, for $100, it would earn $5.12 that first year in earnings for every $100 worth of the business that you owned. So it's a 5.12% earnings yield. Okay, simple enough. Now, if you pull forward the first year of earnings growth on your $100 and your $5.12, you will have your initial investment of $100 plus $5.83. Okay, so what I do is I assume that this $5.83 continues to grow at that 13% each year and accumulates over time. It is not the $105 that grows at 13%, just the $5 starts at $5.12 basically. And so each year, this is how much you would have on your $100 investment. And what I like to do is go 10 years into the future and see what our $100 turns into, which is about $212. So when you put this in a CAGR calculator, you start with $100, you end with $211.77, and over 10 years. And that should give you a 10-year, and the time frame is important here because this will change over time depending on the earnings growth rate and starting earnings yield. 7.79% 10-year earnings CAGR. That is pretty good. 8% is usually the threshold that I use for a buy, right? So this is actually pretty close to a buy. It's only 3.6% above the buy price of $439 using that straight up method that does not assume that there is a recession for the next 10 years. All right, so that looks pretty good. Pretty close to being a buy. Essentially it could be a buy now, given the assumptions that we have here, and given that 10-year time frame, and assuming nothing bad happened. I mean, other bad things than recessions can happen too. So sometimes when you're careful about a recession, you also are being careful about any potential other dangers that can come up along the way too. But you can also miss out, right? So if this stock falls to 400 and I don't buy it because I'm being too conservative, and then rises and produces 15% returns for the next 10 years, I kind of missed out, right? So that's the kind of flip side of being a little conservative. So right now I still have mostly because the rates are still high. Maybe they'll lower them in time before things in the economy eventually kind of roll over. I don't really know. There's also kind of deglobalization risk and other risks that are out there. So I'm just still pretty cautious in general. I'm not really pounding the table on recession, but I don't feel like we're like early cycle. Like there's some, so the danger I think is we have like a stagflation situation that rolls into like a recession. So that's kind of my base case, but I don't have like timing for that. So I'm just kind of permanently conservative right now. But I'm not always actually permanently conservative. Sometimes I take these recession things and I just don't use them. I didn't start using them this time until 2022 or something in the last couple of years. So for 2021, it was all like full bore. I think from like October 2020 all through 2021, I didn't have any kind of recession parameter at all. So it does change. I'm not just like I don't permanently use these. So let's say we want to be cautious about a recession. Well, you could always take these two prices and maybe just layer in, because I do this and I tell people what I'm doing. I try to have pretty specific entry and exit points, only one or two times maybe per stock. But in reality, layering in and out is fine for each person. They don't have to kind of share their results and kind of track everything like I do. So you have a little bit more freedom to kind of do things like that. So that's one way you can kind of mitigate some of that risk and not have to make like some clear decision where at 439.01 you don't buy it, and so with that context, let's take a look at the recession situation. So I actually think I blended. Let me look at my notes real quick. So 2008 and 9 was such a bad recession for healthcare stocks that they'll probably never get that cheap again, unless like communists take over the country or something. So I think what I do is I blend the 2009 and the 2020 recession numbers together, and then I actually add like a 40% buffer above that. So I'm not trying to pick like the exact like worst day of a recession. I just don't want to buy too soon, right? Or to pay too much as we're potentially going into a situation where I could get it really cheap. So the way I do this is I take the low stock price, which is usually listed. I don't usually use the cursor for that. I just look up here. So 1451 in 2008. And then I take the peak earnings. In this case, it would be 350. I create a PE ratio out of that, which I call the recession PE. And then in this case, I raise that by 40%. And that's the recession PE that I use to guide me if there's another recession would be a decent point to like buy the stock. So I created a recession PE for that recession, and then I did one for 2020 as well. So in 2020's case, the low was 187. I don't know which earnings I used. Probably this one that happened beforehand. And so then I used that price and the 1511 for the peak earnings, since earnings didn't fall that time. Usually it's easy because in the recession, the 1 year's lower, like the following year's lower than the previous year. But that's every now and then you run across a weird one like this where that's not the case. So I created those two recession PEs, I averaged them together, and I added 40%. And then I would do the same thing. I would apply that principle to where we are now. And again, so I've been pretty cautious with most of these stocks, and I've been using the actual earnings that we know already happened in 2023. But in UnitedHealth Group's case, I was a little more generous, and I went ahead and used these forward earnings for my peak earnings. Now, if things do roll over, like, let's pull up Humana so we can actually see an example. See how they rolled over here. So the reason that I use these previous, now at one point everybody thought these earnings were going to be like up here, but they were wrong. And that could happen with United Health, probably not as bad as Humana. But it does happen, and sometimes it can happen without warning, as we see. But the thing is, no matter how far this falls, we know what the peak earnings were. So it's stable. And that's what is kind of the secret sauce to this approach. The peak earnings are stable. You can also look at the peak PEs going in to make sure that they're similar. I haven't done that for United Health. But we can do that. So the peak PE going in, assuming we actually have a downturn, which we haven't had. Peak PE going in here is, oh, whoa. Did not mean to do that. Okay. So peak PE, okay, is 22. Let's go back to here. So the peak PE, well, we'll go into the actual peak. Yeah, so it was more like 25 back here, and then as we got closer to the recession, it was more like 17. But the real peak here is like, we'll call it 25. And this one is, yeah, about the same, like 25. This little pre-peak. So we can say, okay, well, if a recession happened within the next couple of years, a year or two, the dynamics that were going on here, it wasn't super overvalued going in, is what I'm trying to say. Sometimes there's a situation where a stock is really overvalued, and that explains this deep drop in the stock price during a recession. So if United Healthcare had a 50 PE this time and only a 25 PE back then, it might not be a good guide to what's going to happen this time. It could be too not conservative enough, or the situations can be reversed as well. So that's something that you can check when you're doing this. So when I do all that, I get an 8.75 recession PE level that I would come in and buy at. The actual average recession PE was 6.25. That's like the most pessimistic situation, basically, if you combine the 2020 and 2008 situations together. So that gives me like a low level, like a baseline worst that I could expect. And then I add 40% to it to just be more realistic that, well, the worst probably might not happen. It's just a broad guess, and I'm not trying to buy at the exact bottom. I'm just trying to buy at a good price that the market has a decent chance of giving you if the external situation arises again. So as you guys have probably seen, that price is much lower. And I explained all that so people didn't think I was totally nuts. In 2008, it actually fell 70% or 75% from the top. And in 2020, it fell 50% without a real recession. And so a lot of times people will look at this and think I'm totally crazy, but it's based on what's happened in the past. So if you're worried about a recession or you just want to be more conservative, I would say the soonest I would buy the stock is 439, and then at 205 or so, that's when I'm coming in with like a full position. No matter how miserable things look, if it looks like the world's ending, still just come in and be brave and assume that if they survive and recover from whatever calamity is happening, you'll do very well, which is probably worth looking at. So one of the biggest mistakes I made was not buying healthcare stocks back you didn't even have to buy them in 2008. You could have bought them all through 2010, 11. I mean, it was just probably the biggest miss, I think. I wasn't like a full-time investor back then. I was just buying a few individual stocks for my kids' accounts, basically, in terms of individual stock investing. But yeah, so I'll just go, well, what the heck, we'll get close to the bottom to see how great these guys did. So 25% per year CAGR. I mean, it's nuts. It's almost a 2,500% return. And those are the type of things where you really, I don't miss out. I don't have like FOMO hardly ever, but what you can do though is go back and learn from your mistakes and be like, okay, what did I do there? Well, I assumed, I listened to the news. I assumed that the government was going to take over the healthcare system or make it non-functional. And if I was smarter, I would have realized that the actual system they were putting in place was actually giving these health insurers a bunch of new healthy customers that were unlikely to get very sick. And so, yeah, I mean, it's like 1,000% wrong. And, I don't think I ever really thought about it enough as an investor back then. Maybe if I was investing every day like I do now, I would change my mind. But it's definitely, and I don't let politics involve any of I'm very neutral. I just try to look at how things are and not how I want them to be or how I think they should be when it comes to government policy and things like that. So those are some big lessons that I learned from these healthcare stocks back then that I definitely apply now. So I hope everybody found this useful. I have free membership, a free membership level on Patreon now, and I'll put that link down in the description. And then I also have an investing group on Seeking Alpha, and if you join the $5 Patreon group, you can get a big discount to the Seeking Alpha investing group, and I'll have that link down in the description as well. And if you found this useful, hit the subscribe button. If you have a request, several people requested this one, so I kind of bumped it up to the top of the request list. If you have a request, just put it down in the comments section, and I'll get it on the whiteboard behind me, and eventually I'll make a video. Later.